What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is March 8th of 2020. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, we're going to be talking about what may be the most important topic when it comes to the world of finance and economics, but literally no one is talking about. And it's probably one of the biggest reasons we're going to see one of the greatest rallies yet for not only gold and silver, but also for Bitcoin and cryptocurrencies alike. So for those of you out there who are engaged in the cryptocurrency space, I think this is extremely relevant. And if you can stay tuned with me, there's a lot of interesting data we're going to be talking about. All right, so let's go ahead and start with a precursor here that's very relevant for a lot of you out there. As I mentioned, I know many of you here, being part of the Data Dash family, you're probably very much engaged in cryptocurrency markets. Like myself, it's where I'm most exposed personally. And again, if we take a look across the board here in cryptocurrency markets, we can see that over the last 24 hours, we've had about a general 5 or 10% pullback across the board, depending on what cryptocurrencies you're taking a look at. And to many people, this can throw people off. It can get people thinking about short-term price action, and vice versa. When things are going really great, it's very easy to FOMO or get caught up in the market price action that's going on within the cryptocurrency space. But I want to go ahead and really emphasize a key point here, guys. You all know, if you follow the channel consecutively, and if you don't already, definitely subscribe and hit the bell icon. We always love having new people join the family. The major thing that I always stress is to focus on longer term trends, to focus as a macro trader would on the longer term swings in markets that are not only much more predictable, but much more profitable. And that's generally focusing on a trade that we can hold for over 6 months to a year to possibly even 2 years, right? Well, in this case, with this time frame in mind, one thing that I see people making a big mistake on as we jump into this key issue that I want to discuss in the video is that people are focusing way too much in the short term here. We are seeing people focusing on the day-to-day price action when in reality, the longer term trend is showing us here, for example, on Bitcoin, that something big is coming soon. We are seeing a big set of price action set up here where we've got an ascending line of support, a descending line of resistance, building a wedge here for a major breakout to either the upside or a breakdown to the downside. Again, how that's going to move is going to have to be determined by you as an individual. We'll get back to this in a little bit. Along with that as well, altcoins as well. A lot of people are saying, Nick, what altcoins do I buy? Is it time to buy altcoins? I've already been talking about this for a very long time, guys. The thing I emphasize here is not to focus on the day-to-day. I don't get bullish on altcoins when they move up for a week. I see whether or not they're going to break out on the longer-term trend. And just like altcoin dominance in this case, or basically reversed Bitcoin dominance, is showcasing a building of a wedge here, looking like it may have a breakout, or again, possibly keeping open in mind, a breakdown. And not to mention as well, again, as people get caught up in the kind of craziness of the market here, again, we're seeing here through the fear and greed index, these kind of smaller influxes to the upside and downside here. There's no clear, concise trend just yet. So when there's no trend here, right, when it comes to crypto markets, we shouldn't fret. But we do have something to be concerned about on the global stage. And again, I'm not going to mention the name of it, but you guys know what this is if you've been keeping up with the news. But long story short, right, we have this issue on the global stage in this case that's affecting everyone nearly. And it's definitely had an effect on the stock market in this case. We've seen a major decline over the last month in all the major indices, nearly around anywhere from 10 to 15%. But this isn't even what I want to talk about precisely in this video. Again, we'll come back to stocks in a little bit. We can see here again, global futures here. There we go. Global futures across the board definitely taking a hit, right? We even have some indices, for example, like the Tadawul in this case, dropping nearly 8% overnight. So what's been going on here across the major indices? And what really at the end of the day has me concerned? Well, it's not simply the performance of stocks in regards to the global fear in the sense of the issue that everyone's concerned about. No, it actually has to do with the Department of Treasury. Okay? So I know this is already looking boring to many of you right now because it's a government website, and quite frankly, I get it. I fall asleep when I look at government websites, but this is probably one of the most relevant links on the web right now that you could be looking at when it comes to financial markets. It's public knowledge, but no one looks at it in a lot of cases, except a few select traders who understand these markets, okay? So I want to go ahead and talk about this because even though it might not seem enticing, it is highly relevant. So we're going to take a look here at basically what's the Treasury Yields. And for those who don't know what Treasuries are, it's no big deal. Treasury is a government bond. It's specifically the U.S. government's bonds. And there's a few different time periods where you get bonds from the government. So for those of you who might not know this, it's no worries. If you don't know what a bond is, basically a bond is an IOU. It's debt in a sense that says I owe you a certain amount of money over time, a previous principal that you gave to me, a certain amount of cash, and along with that as well, some form of yield or interest in this case on the bond. And those yields vary over time, right? So understanding these key elements here, right? Understanding that they can change variably over time, let's go ahead and take a look here at the U.S. Treasury yields across the different maturity dates. So we have a chart here. We have the 1 month, the 2 month, the 3 month, the 6 month, the yearly, the 2 year, the 3 year, 5 year, 7 year, 10 year, 20 year, 30 year. What do these mean? It means that if I were to buy a 30-year Treasury, right? In this case, I not only should usually expect a higher yield of some sort because I'm committing my money for a longer period of time, but along with that as well, it means that that debt is not going to be fully paid back until 30 years later. Okay, so the shorter the time period here, the more likely I'm back to get my initial capital plus some form of yield, right? The yield on the Treasury. But as we can see here, generally speaking, you not only see a general trend here where the rates, the yield goes higher in this case as the time progresses, right? As you have longer holding periods. And again, you can always sell the bonds. It's one thing to keep in mind as well to someone else. But the major thing you notice is as we go basically vertical in this case, rather than focusing on the horizontal side, we'll see that the yields change over time. And they usually change by, if anything, somewhere like 3 or 5 basis points, basically 3 or 5% of an entire percentage point. Not much at all, right? The day-to-day changes on these yields are not too significant. If anything, maybe you get a little bit larger changes here in the 10-year, the 20-year, and the 30-year. And that's understandable. The yields are going to change a little more dramatically because these treasuries are being held for a long period of time, and they're a promissory note over nearly 10 to 30 years in this case from the government, right? Now, the key thing to take in mind here, though, is that treasuries are a very favorable investment to most people because they're seen as basically a guaranteed return of some sort that a lot of people talk in finance. Because in this case, you have the federal government of the United States backing these notes. It is probably one of the safest bets you can get. I know we talk a lot about the U.S. government being bad, but when it comes to traditional financial products, guys, you are more likely to be paid back your money from the federal government in the United States than for the federal government to enforce that you own some form of stock or property, right? That's the key importance of the Treasury here, that it is an IOU promissory note from the government, because if they stop paying back on these debts, then in this case, that no one's going to keep giving them money, right? So the government wants to keep financing its debts. So treasuries are the tool for that. All right, now I've rambled on enough here. Let's go ahead and talk about what's really bad here, right? So you can see here, over the course of this year alone, we've seen points change variably to the 1 to 3 month here. Across other treasury yields, not too much of a significant move. But something happened here towards the end of February and into the early month of March that has got me severely concerned. And that was the near half, basically cut in half rates or yields in this case in the treasuries from late February down here to March 6th. So for example, the 1 month in just a matter of less than 2 weeks has gone from around 1.59% yield on the 1 month treasury down to nearly 0.79%. Nearly cut in half. I mean, this is dramatic stuff, guys. This is huge. And no one's talking about this right now, right? Actually, sorry, I'm saying it's nearly half. It was cut in half. Sorry, I was going through some struggles with the simple math there. But you can see here, we're seeing a reduction in half. And then you see that across other treasuries here. For example, in the same time period here, back here towards late February, right? Coming down and being cut more in half, more than in half, right? We're seeing the yields across the board here starting to decline towards less than a percentage on a lot of the treasuries here. Very few treasuries are not trading below 1%. The only two exceptions are the 20 and the 30 year, right? So what does this tell us here about what's going on, right? Again, why is this fearful to some degree, right? This market doesn't affect you guys, right? I mean, that's at least what many people would see when they look at these treasury yields. They're like, oh, 1 or 3%, I don't really care. I don't own any treasuries. I don't really care about what's going on in treasury markets. Well, you should, because what's going on in treasury markets is a phenomena that we've seen globally, and it's continued to grow. And if the United States joins suit with it, it is going to be a massive issue for traditional markets. But good news for a lot of hedging assets, such as Bitcoin and gold, as well as silver. and that is the growth of negative yielding bonds. Okay. Now, for those of you who have stayed tuned to the channel over the last couple of months, you've probably heard me actually talk almost nearly for a year now about the phenomena of negative yielding bonds. And negative yielding bonds are where you take an IOU from a government or from some kind of entity, basically a debt promissory note, and you expect to pay them for it. That's right. You're not getting a yield for taking on the debt. In fact, you are paying the individual who's borrowing a yield. It's similar to banks that are experiencing negative interest rates, where basically you have to pay the bank to deposit your money. Warren Buffett famously came out back a couple of months ago, or about a year ago, talking about this phenomena and said that for one of his European companies where they have negative interest rates, he would do better just stuffing his money under a mattress. At least you're not losing anything in regards to your euros or your dollars. Well, in the case of bonds, this phenomena is existent too. And a lot of the yields across the world from major countries such as Japan or Germany have started to experience a negative return. Now, many people would say no one would buy these, right? Well, what's the reason for buying them? Well, there's really two reasons for it. There's first off traders who buy it because those traders are following the phenomena that commonly happens when rates decline. When yields decline on when the yield declines on bonds, the price tends to go up. I know, again, it might not make sense. It's what happens, though, in bond markets, plain and simple. Prices go through the roof. And if you want to take a look at the value of these bonds as the yields have continued to drop, be my guest. Go look at the 10-year. Go look at all the different government bonds. The 2-year, they're spiking to new highs in many cases across a variety of countries, especially in the United States. Right? So there's that reason as well. And there's another reason as well. The government mandates that people's pension funds, retirement portfolios, hold treasury notes, hold government bonds to some degree. So for those of you who do have retirement accounts and maybe sure mainly exposed to crypto but have some form of retirement, a pension fund, or some kind of investment portfolio, this is extremely relevant to you because this starts to mitigate the returns of other asset classes across the board in your portfolio. Now, we understand this phenomena here. We can see that even back here when we started talking about it really heavily back in July of 2019, we saw a general decline here in negative yielding bonds. But we've recently had a $3 trillion spike back up. $3 trillion in government bonds added to the total number that are now providing a negative yield. And this is, again, a mixture of some corporate bonds as well, but it's mainly government notes in this case from a variety of different countries. Treasury notes, government bonds, whatever it may be, right? And the important thing to note now is that the United States, the unthinkable, the United States may actually join into this party of negative yielding bonds, where U.S. Treasuries start to leave you with a negative return on your capital, if you can believe it. I mean, this is something that, again, people thought was insane to consider that the United States could even see something like this within the next decade, as we were tailoring towards nearly 3% yield on the 10-year, in this case, the 10-year Treasury, back in 2018. But we started to see this sudden spike here, a near percentage decline, even in a matter of just a couple of months here of the 10-year. And it's falling like a rock right now, along with the other different types of treasuries in the U.S., different maturity periods. So we see this here in the 10-year. The 2-year is dropping just as fast, nearly down to 0.5%, right back down to where we were in 2016 and 2015. And it looks like it might fall through and go down below zero. So what does this mean, right? Why is this happening? Well, the first thing to understand here in the sense of why it's happening is because the Fed is sharply cutting its interest rate, the Fed funds rate. We went down from nearly 1.75% down to 1.25%, a 50 basis point drop, the biggest drop the Fed has taken on ever since it started quantitative tightening and reducing quantitative easing, as it started to rise interest rates and bring up the cost of capital, and in this case is now reversing on that, right? So it looks very much like in this case the Fed is going to 0% in the sense of its base Fed funds rate. And the Treasury yields are speaking to that. The sharp drop here is not just happening in the sense of just pure coincidence. You can see here that during the time when the Fed increased rates, as it started in 2016, Treasury yields increased as well. there's a near direct correlation here. And as we start to see a decline in Treasury yields, they almost serve as a precursor here in signaling that the Fed is likely going to cut to some degree. So as we see these dropping more and more close to zero, it likely means that the Fed is going to be dropping interest rates down to zero. Now, here's the interesting portion here, guys. Treasuries are usually the safe haven that people turn to. But what happens when you can't turn to a Treasury note and get a yield of any sort, even to hedge against inflation? And in fact, you might start losing money. That's a very, very interesting ramification for financial markets. And it's interesting during a time when we take a look across the board at equities and we see that equities are selling like, they're falling like a rock in this case, right? They're selling off like crazy. We've seen the NASDAQ, the Dow Jones, and the S&P 500, some of the strongest stock market indices in the world, who have performed better than most indices across the world, now seeing sharp declines across the board alongside other global players. We also have, for example, a decline in stock buybacks, which have been propelling these markets forward. And eventually, I think we'll also see a decline in dividends, but it's usually an outlier that happens after a recession kicks in. So we're seeing the weakening signs here across the board. Stocks aren't performing well, right? Property markets right now starting to stagnate a little bit, right? And now we're starting to see here that the Fed is dropping its base Fed funds rate. And now we're starting to see here that treasuries are following with their yields. Now the value of the bonds are going through the roof. For those of you who are trading on the short term, you're making good money. But all the people who have it in their pension funds and are mandated to hold these treasuries in their retirement accounts, they're going to be out of luck when the end game comes. So this is very, very important to understand, guys, because these are trillion-dollar markets, multi-trillion-dollar markets, to be frank. And they are a part of the underlying plumbing of the U.S. and global economy at the end of the day. If these treasuries start to provide a negative yield and people cannot finance debt, or people in a sense start to basically backfire and stop financing government yields, this is huge. I mean, this is an inflection of so many things. It means losing money in your bank account due to the negative Fed funds rate. Along with that as well, negative yields on treasuries, one of the most seen as safe assets in the United States and in the global economy. Treasuries are usually in high demand across the world from large-scale investors. And we're seeing equities sell off. So where do people turn to in a time where there is global fear, where you're worried likely that central banks are going to start printing again, are lowering the barrier to getting new credit through lower rates in the sense of the Fed funds rate, where there's no safe haven to put your money now due to a near negative yield on treasuries that doesn't even keep up with inflation and it may start penalizing you for holding them. And then also an equity market that is overinflated, bloated, and ready for a decline after the longest economic expansion in history. It's Bitcoin. It always has been Bitcoin, and it's going to be Bitcoin this time around. We have talked extensively about the stock to flow model. We've talked extensively about the halving. And boy, is it coming at a time where it is meeting the narrative here in the sense of what's going on the global stage. Nothing right now could be more valuable for the world economy than something that is outside of the world of central banking and is not only digital, but along with that as well has a fixed supply and is about to see a halving and the issuance of new coins every 10 minutes. This is the exciting and extremely interesting narrative that Bitcoin offers. If you guys doubt for a second that Bitcoin can't get up to nearly 100,000 as the stock to flow model is showcasing here, I would say to take some perspective here. Treasury markets are a multi-trillion-dollar market. Equity markets are a multi-trillion-dollar market. Gold, as a market alone, as a commodity, just hit $10 trillion at its valuation. Bitcoin right now, at this price, is sitting somewhere around $150 billion. To say that Bitcoin could do a little more than a 10x here in this case and go to 100K is betting that Bitcoin is nearly going to go to a little bit above $1 to $1.5 trillion. I think it's rational. I think it's very reasonable. If you think about what's trending with most youth in the United States and people across the globe, I would say that Bitcoin is probably the most interesting asset to many people. A good kind of measurement, I would say, is if you take a look at the users on platforms, these new retail platforms for traders, for things like Coinbase and for things like Robinhood. Robinhood is more focused on stocks, and Coinbase is more on crypto. Coinbase has far outpaced the amount of users that Robinhood has seen, for example. And that's not to disparage or go off on a tangent here about these different platforms, but it's a sign here that crypto is the new asset class. And if you aren't seeing this, if you aren't paying attention to the data science models, and if you're not focusing on the long-term timeframes, guys, you just might miss out. So, anyways, I've rambled on enough today, guys. I hope you all really liked this video. If you did, please drop a like. And for those of you out there who may not have exposure to the cryptocurrency market, there's a lot of different platforms out there. One of them that I use as well is eToro. Now, for those of you who may not know, eToro is one of our sponsors here on the channel, and they're a social trading platform that allows you to interact and engage with traders across the globe. And for US traders, they recently launched their new copy trader feature, where you can copy many people, including myself. You can view stats real time. You can see, for example, my performance on a month-to-month basis. You can also see my current portfolio holdings, and you can also see a chart of my performance. Now, I'm signed into my profile, but if I wasn't, you can see here a blue copy trader button where you can simply click the blue copy trader button, and you can trade alongside me real time at the exact same prices at the exact same time. So if that interests you, check out the link down below in the description. But that being said, everyone, thank you all so much for watching. And again, I really want to emphasize, do not focus on the short term. I can't give you guys any financial advice, but I can tell you something when it comes to just analyzing markets. Don't worry about the short term. Plain and simple. Focus on the long term. Build your strategies to trade on the longer term cycles. Reduce your stress factor when it comes to investing and trading, and focus on what's going to make you profitable in the long term. All right. Anyways, I hope you all are having a fantastic day wherever you are, and I'll see you all in the next video. Stay tuned.